Once again, I just want to thank everyone for joining us for another one of our financial wellness webinars. We've been doing this for a few years now, actually. I'm very excited about that. We do a few throughout each year with varying themes. So today's will be on long-term care planning, which I think is a very important part of anyone's financial plan. It's the biggest speed bump that anyone will experience in the planning process. So it's important to have something in place. We've done previous webinars on, we've done estate planning. We've brought in a partner of a local estate planning firm, end of life planning. We've brought in the owner of a funeral home to go over some of those decisions that need to be made. Identity theft. We've brought in chief technology officer of a major law firm. And so those are all also available on our website. It's been, I believe, Stacy, we said it's been about 2 years since we've done this long-term care webinar. And so wanted to refresh it, give some updates, and put it back in front of people. As I said, it's important, and it's only getting more important every year as more Americans move towards the long-term care needs and as it gets more expensive during that time. So, I will start this with just introducing Stacy. You've been in this industry and in this space for years. You're multi-generational, working in a family business, and you've been helping our firm for a number of years, giving us access to and the knowledge of many different products and opportunities in this space to assist our clients. So I just wanted to thank you for joining us. I'll let you do a little further introduction on yourself and on Shields, and then jump right into the webinar.
Great. Thanks. Thank you, James. And it's great to work with you today. And I want to thank everybody for taking their lunchtime to be on this call with us to learn about this important topic that the problem is never going to go away. And as we live longer and we are healthier longer, the need for long-term care obviously becomes more prevalent. A little bit more about me. As James said, I'm the director of long-term care marketing at Shill's Brokerage. Been in the industry for quite some time, 35 plus years. I probably could put a couple pluses at this point, working in health design and educating folks on long-term care planning and issues. I am certified in long-term care planning. I have my CLTC designation as well. And a little bit about Shields. We're to the east of Brophy Wealth Management in the quaint town of Exeter, New Hampshire. However, full disclosure, I'm sitting in Barrington, Rhode Island. So I like to call it Shields Brokerage South. I've been down here for quite some time, but lived in New Hampshire, Maine, and now Rhode Island, doing this exact position, which is wonderful. Shields is a family business like Brophy Wealth Management is, and we are independent. So we don't represent just one product. And our goal is to work with professionals like James, helping him help you all with products and planning solutions in life insurance, long-term care, disability, senior health products, and employee benefits. So we're a middle person, so to speak, in the industry. So that's a little bit about us, and what we'll be covering today, or what I'll be covering today, is I'll review a little bit of the Medicare and Medicaid and understanding how that works in the long-term care discussion, talking about the different programs that are available, the traditional versus the linked benefit space, how the products work, and when's the best time and how to purchase them. So getting right into the meat and potatoes, if that's what we're having for lunch today. Often people confuse Medicare and Medicaid, and more importantly, people often think that it is working that is a long-term care solution. So let's just break down a little bit between what these two do. So Medicaid, I like to always look at the suffix there. Aid is like your financial aid. So if you don't have a long-term care plan, and if you don't have a good amount of assets, Medicaid becomes that long-term care planning choice for a lot of people, but it's very limited. First, you would have to spend down your assets to a very minimum level. And if Medicaid is going to help out, it's primarily nursing home directed. So the place where people don't want to go is a nursing home, but that's where Medicaid would be the choice for you. And then they would be making that choice because they're going to be looking for Medicaid beds in nursing homes. And I'm sure you've been hearing how their nursing homes are closing. There's less availability of nursing homes. So it's not the best solution at this juncture, and it's very limited, and it's designed for people when they're in a financial minimal situation. Um, Medicare is our health insurance for 65 and older. Also, you think of care and health insurance, your doctors, your hospitals, prescription drug cards, and people will then also purchase a Medicare supplement because Medicare doesn't do the full coverage on their own. Often we see Medicare helping out for some types of long-term care services, but they are limited and there are some criteria. What I like to say is that in order for Medicare to be part of a long-term care scenario, the sun, the moon, and the stars all need to line up. First of all, you need to have 3 nights in a hospital for a condition. That condition itself also needs to be recuperative in nature. So it broken pelvis, really severe illness like a heart attack, something like that, something you can get better from. Alzheimer's is not something you can get better from. That's a distinguisher. And then the care that Medicare will help out with would be skilled care. And either you're going to have skilled care visits in your home or in a facility. So skilled care visits in your home, they're not coming and helping you get dressed. They're not preparing a meal. They're coming to do physical therapy, occupational therapy, speech therapy. A nurse may come to take care of your stitches, changing bandages, those types of things. Or you're going to have the 3 hots in a cot, I like to say. You might be in a skilled nursing rehab facility, getting better from that condition that you have. Obviously, you're there for 24 hours, but the reason why you are there is for the same therapies, the physical therapy, the occupational therapy, or for, taking care of wounds or anything on that, IV therapies, even respiratory therapies. So that's where Medicare helps out. Now, if this criteria all happens, Medicare is going to cover the first 20 days in full. They'll pay for those services. The next 80, they're going to co-share with you. In 2025 rate, Medicare is going to cover $209 a day. Then you or your health insurance, your supplement plan may pick up the difference. At day 100, they're done. If you didn't recuperate, at this point, you should be done recuperating back home, back on your feet, and better from that condition. But Medicare will not continue to pay in that situation. And James, I don't know if you want to add anything or if any questions pop up, we didn't talk about that ahead of time, let me know.
Oh, yes, thank you. Just briefly, for those who have joined us here, you do have the option in both a chat feature and a Q&A. If you have questions, to please put them in that chat. And as either it's a topic Stacy's addressing, I'll jump in with those, or at the end, we'll go through anything that's been unanswered. So again, on people's screen, there's a Q&A option and a chat. Either of those is fine. And then also for those who just joined us, just to reiterate, this is being recorded and the slides will also be available on our website after the call.
Wait, okay. Let's just talk a little bit about the different programs out there that you can purchase to be insured under for protecting against a long-term care event. There's traditional products, and then there's linked benefit, and then there's also alternative programs. What was out there originally over 40 years ago were traditional long-term care policies. And James, I know you probably have some clients, and I know we do here at Shill's Brokerage that purchased policies 25 years ago, and they're starting to utilize them now. The traditional product provides care in any setting, in your home, assisted living, adult daycare, or facility care. Facility be a nursing home or even memory care. When you purchase this policy, you have a defined known benefit. You know what you're buying today, how much you would be getting for your long-term care services on a daily or monthly basis, and how long it would last. How much money would it pay out ultimately? The traditional products can offer tax deductions of premium, and the benefits are tax free. Of course, you always speak to a tax advisor about that. And the traditional programs can have a better price point. They can be a bit more affordable. They can offer shared benefits, and when you're working with couples where you can share each other's policies, that can help ensure the overall family protection, but it just gives a little bit more of a price point affordability because you're sharing in that protection pool. And it can offer, and this was something that came out about 15 years ago, partnership protection with Medicaid spend down. in the event that you need more care and you go to the state for Medicaid for help. And a little bit on partnership. So the intention of partnership is to encourage the purchase of long-term care while alleviating the burden of using Medicaid on this, using the state Medicaid program. By having a long-term care partnership plan, your long-term care policies, when your long-term care policy is exhausted, and if you look to the state for more help, it would help with the asset protection and spend down. Partnership may protect an amount of your assets from that spend down based on what the long-term care policy paid out first. Okay, so it's doing a dollar for dollar asset protection against Medicaid in a spend down situation. What's nice with the partnership protection is that, let's say you purchase the policy in New Hampshire, and it's a partnership policy, and New Hampshire has a partnership plan going on, and you move to Florida or Arizona, they have partnership protection there as well. So you're not stuck in your state here and have to stay here. You could move to another state and still have the availability of the partnership protection. A state like New York, you would not, because New York doesn't have partnership protection. I know, James, you and I have talked about that in the past with some clients.
Which is incredible because they were one of the first states to offer the partnership, and they've kind of legislated themselves out of it.
Right. There was the original partnerships. This gets into long-term care, like geeky nerd stuff, but they were like the cavemen. California and New York and a few other states had an original design for partnership and asset protection, encouraging people to get some protection first through private policies. But it didn't align with if they moved outside of the state. So those states aren't even really, there's no insurance products that are offering to align with those programs anymore as well. So you can't get a partnership policy in New York. You can buy a long-term care policy, but not one that works
Not
with
partnership.
because it kind of dinosaured out. It extinct itself, as you said. Exactly. So I'll make sure I move along here. And here's an example, not in New York or California. So if Fred has a long-term care partnership policy and it paid out $200,000 in long-term care services for him, that was his policy benefit pool, and he exhausted it and he needed more care. But since his policy paid out that $200,000, an equal amount, $200,000, is protected from the Medicaid asset limit in a state recovery program. Medicaid's asset limit is generally $2,000. That's what you'd have to go down to. That's all they would allow you to retain. This means that Fred would be entitled to $2,000 in assets plus the $200,000 that is protected because his long-term care policy paid that, allowing him to retain $202,000 in his own, we'll say in his back pocket. Okay. If Fred's overall estate is at $400,000, he would have to spend down $200,000 because he gets to keep $200,000 out because of his partnership protection from his policy. He'd spend down $200,000 of his own assets. He could retain his home and bank account outside of that, which he could then pass along to his family. But then Medicaid would pay for him to have a bed in a state nursing home. So I could do 30 minutes on partnership alone. But its intention is to have some protection privately first, rewarded by not having you have to spend on all your assets if you then needed to go into a Medicaid scenario. But really the goal is to help stay out of the Medicaid situation. I hope that helps. One of the cons, and probably the biggest con with a traditional long-term care policy, is that the premium rates, the rates you pay to maintain the policy that usually you pay every year until you use it or pass away, are not guaranteed. So there's an elephant in the room on how much will these rates go up over time and how do I plan for that? We can help protect ourselves with that by some of these programs will offer limited premium payment features where you pay more premium up front, but then it stops. I like to call it a 10 pay is one of the examples. So you pay premium over the course of 10 years in this example. It's a more front-loaded premium, so it's more expensive to get into. But after that 10th year, your premiums are paid up, the policy is in force, it continues to grow with you and follow you until you use it, but you never have to worry about any future rate increases. As an example, I purchased a 10 pay policy when I was in my 40s, And it's been paid up for quite some time now because I'm way over 40 now. So, but I don't have to worry about future rate increases. So 10 pays I like for, people in the younger age group where you're still working and you can afford to pay that premium. The other con with traditional long-term care policies is if you never use a policy, which personally I don't want to have to use my policy, but if you don't use it, nothing comes back to you. All right, there's no gain in any way. So people feel they might have wasted the premium. There are some riders we can add to the policy so you could have a return of premium. They're seldomly not utilized or purchased because they are very expensive. So it's better to, I like to say, get in front of the discussion, work with James, plan. I know you'll see your cost of living will go up, taxes go up. This is something you can bake into your financial plan to offset future rate increases. If you get in front of it, then you'll be prepared if and when it happens.
And Stacy, with that too, obviously no one has a crystal ball, but almost all of the increases that I have seen have been policies that 20 years ago, when they decided how should these be priced, all the assumptions change. And so it's not new policies typically that see the increases. It's ones that were 20 years ago. And when they do it, it's my understanding they have to petition the state insurance agency to be allowed to make that increase. Uh,
Correct.
and so,
Yeah,
okay,
the executives can't decide they want to go on a cruise. So in order to, have to file for a rate increase, they have to go to each Department of Insurance in the state. They have to prove why they need to have this rate increase. They can't pick on you, James, if you're on claim. They have to pick on all those policyholders in that series and justify it. And the states are not they don't make it easy for those rate increases to happen. And they are on older legacy policies, I'd like to say, that have been around 25, 30 years. And they were based on assumptions. They didn't know about Alzheimer's and how long someone was on claim for Alzheimer's. They weren't working with the assumptions that people were living into their 90s and their hundreds. Okay. So,
right.
and that with chronic illnesses, we can live a long time where I don't know, James, when you and I were, well, you're much younger than I am, but when I was a child, people died of heart attacks and people died of cancer. Now people live and manage those for a very long time. And then obviously the need for long-term care becomes more prevalent. So
Correct.
the current policies that we're working with now, the actuaries have designed, have baked in the assumptions of people living longer, the premiums today versus a long time ago when I was purchasing it are much more expensive because they know they need to have those reserves in there for the promise to pay out 30, 40 years from now. Does that help?
That does, yeah. I just
Okay.
like to make that clear because a lot of times when people are seeing these they come to me with a concern about the rate increases, it's because mom and dad's policies did this, or as an older sibling or older friends did this, and it made a concern. And so again, no one has a crystal ball. It could happen, that is in the policies. It just I like to clarify that. Oftentimes these are, as you said, 20, 25 years ago, and they made a lot of assumptions, including most of the time, like with life insurance, not everyone keeps their life insurance. They retire, they
Right.
let it go. Very few people let these things go. And so even those sort of assumptions weren't have been, as you said, baked into the new premiums. And so it's less likely to
Correct.
be
You know, they,
rate
they,
increases.
they, yeah, they made the assumption of a much lower interest rate environment, which we've had for quite some time. They also assume they've now assumed that people are retaining these, they are not lapsing them. And the other thing too is that the underwriting to qualify for the coverage is much more stringent than it was 20 years ago. So, they've sharpened their pencil on those three big points. But I don't have a crystal ball. I guess I would anticipate if I were hanging on to a policy for 30 years or so to probably anticipate maybe a couple rate increases that might equate over that period of time, 30, 35%. Just a
Mhm.
guess. Could be more, could be less, but for that long and it wouldn't be every year, obviously. They just can't the due diligence to try to prove that to the state would be too much.
Sure.
Okay. But we can also avoid rate increases. One of the things when we work with the linked benefit products, which is what we're using with a link benefit product, which is also sometimes you might hear in the industry hybrid or combo. Every time I hear combo, I think of those snacks you get at the gas station. But so I like to refer to it as a link benefit product. We're using a life insurance product or an annuity product. So we're using those as the chassis, and then add on a long-term care rider. And so because it has a true long-term care rider, you still have the exact same availability to have care in your home, assisted living, the adult daycare, facility care, memory care. So you have your choice in any setting. But here's a couple of the pros, unlike the traditional. If you don't use the product, say you just drop dead and you never utilize the long-term care, a death benefit goes to a beneficiary. So there's a pro. If you change your mind, there's a new technology out there, there's something new happened in your life, there's a new program, a different way you want to utilize your funds, you could surrender the policy because there's a cash, because it's a life insurance product, or with the annuity, there's value in there that you can surrender. The other, or you use it for long-term care. Your best bang for your buck with the product is the long-term care benefit. That's the richest of the three columns. But I like to say live, quit, or die. Live, use it for long-term care, pays a long-term care benefit. Die, pays a death benefit. Quit, you want something back, you'll get something back. With that, in the life insurance model, if you're having a recurring premium, and some of the products do have recurring premiums now, the rates are guaranteed. Don't have to worry about it. So that's kind of the fourth little caveat, is so you can have a rate guarantee, because life insurance, the rates are guaranteed. An annuity, it's a single premium, so you don't have to worry about a rate change. Funding the product is also fun because you could repurpose some existing life insurance that you have out there that may be building cash value, or an annuity that's outside of its surrender, that you could repurpose those products if they're meeting the intended purpose is not needed anymore, why you purchased those policies originally, you could repurpose those funds into a life LTC product or an annuity LTC product. So you don't have to come up with new dollars. You go find some dollars in some existing policies that you may have. And so that's another nice way that you can do that with a linked benefit product, but not with a traditional. As I said, you have more flexibility with the product, but the con is with that flexibility, there's a higher price point. Some of these products, we have many choices out there, but not all of them have a shared feature, and that can help with pricing. But we don't have as much choice out there in the marketplace for shared products. And some of them do offer premium to pay, recurring premium, we like to say, up to age 95 or 100, but not all of them offer that. So we tend to fall into a 10 pay or a limited pay, 10 pay, 15 pay, or 20 pay, 5 pay, or single pay. And a lot of people will stroke a check, lump sum, and be done. And the big one is it's not partnership qualified. So this will not work in that partnership with a Medicaid spend down protection. So that's an option that you would just have to decide that you don't need that as a backstop for you. And as I mentioned before, it will come with a little bit higher price point. I do want to add, it's not here on the slide, but there is still some tax availability of premium tax deductibility, and the benefits will be tax-free for long-term care. Again, talk to your advisor about it, but on the long-term care portion of the product, it is priced. You can see tax deductibility in that feature as well. And so how does a long-term care policy work? What I like to say is that there's a few moving parts. And the first thing, before you can utilize your policy, you need to qualify for the benefits. The criteria is you have to fail at activities of daily living. Usually it's 2 of 6 is the standard language now, or a severe cognitive impairment. The activities of daily living are eating, bathing, dressing, continence, toileting, and transferring. If you can't do 2 of those, or if you have a severe cognitive impairment, and your doctor is certified you as chronically ill, and that means that the condition you have is anticipated you're going to need care for more than 3 months, then you would be considered benefit eligible. It's like a broken arm. I might not be able to dress myself or bathe myself, but I'm going to be able to do that before 3 months. So it's not, that would not be a qualifying event, as an example. So once you are benefit eligible, then you need to work through the moving parts of the policy. The first criteria is there's an elimination period. That's a time that you need to pay for your care before the policy will pay. And they vary. We can have 0-day elimination periods for home care. Often people select a 90-day elimination period for either home or facility, but there's always a time that you need to show or wait through before the policy will pay. The policy then has what we call a benefit amount, is either daily or monthly. So they're going to either reimburse your charges on a daily basis or on a monthly basis. And then what we have is a benefit period. I like to refer to it as the pool of money. So that's how long your policy will last and how much money comes out of your benefit amount comes out of that pool of money on a daily or monthly basis until the policy is exhausted. And we do have some contracts that have unlimited benefit. I have like 2, so.
Yeah, those are also, as far as I know, where you can't get that anymore. Those are those 20, 25-year-old policies.
I have 2 currently that offer unlimited
Oh, they currently
benefit.
offer it.
Yeah,
Wow.
one in the traditional space and one in the linked benefit space.
We should talk, though not many people need an unlimited benefit, but we should talk.
You, again, back to that crystal ball,
Correct.
right?
Correct.
So, people are going to look at their own personal experience. How long did mom, dad, aunt, uncle, grandparent, how long did people help them get through the day? And that's often is how people often make a decision on what they need for care. Or they're going to look at the planning you're doing for them and how much is their portfolio. And then they're going to develop a plan to offset to ensure that, use that as the number. Other moving parts of the policy is we add an inflation benefit rider that will have those benefits grow over the course of time because, as you say, you're hanging onto these policies for 20 years easily, if not longer, and you want the benefits to be meaningful today and in the future. Though the benefits will grow, but the premium does not change because the benefits are growing. And on the products that I'm talking about, these are not linked into whatever's going on in the stock exchange, nothing was happening in Wall Street. So it's
Thank goodness.
guaranteed growth, no up, no loss, and no premium change because your benefits are growing. So it's an important feature to add in. We can add other features like 0-day elimination period, survivorship if the spouse dies, that surviving spouse's policy is paid up, return of premium features, and even some cash features. So there's some enhancements we can add always for premium price points. And then there's other deciding factors on programs that offer reimbursement. So they're utilizing we always need to utilize a licensed professional in a home, assisted living, or skilled facilities, and they'll reimburse the charges up to that daily or monthly benefit amount. Or we can have a cash benefit, which regardless of who's providing the care, once you're benefit eligible, they just send cash to you. So there's lots of good choices that, as a LTC nerd, I love to really get into the weeds on that. And again, could have another call just talking about it. So here's an example of how a plan would flow. We have a 60-year-old male here, and he has a plan design. He picked a 90-day elimination period. His LTC benefit amount is starting today at $5,000 a month. So if he needed care, if the bill was $8,000, the charges are reimbursed, he would get $5,000 a month. His policy pool, his benefit amount, his maximum benefit amount is starting at $185,000. So he bought the policy today, bam, is $185,000 in the pool of money for him. If he used that $5,000, if he had charges that were $5,000 a month every month, that would be done in 3 years. But the policy shouldered the cost, not him. So that was great. We put into this policy 3% compound inflation. That's growing every year at 3% compound. By the time he's 80, 20 years from now, that $5,000 has grown to $7,800, and his pool of money has grown to $288,000. And if he keeps on going, hasn't used the policy, again, the compound is going to continue to go until he's on claim. And even when he's on claim, the benefits will still grow. The cost for this ballpark for a traditional product would be about 3,000 a year. And for a linked benefit product for a recurring premium, it would be about 5,000 a year. So the differences between the two, that 5,000 is guaranteed, rates won't change. If he doesn't use it, death benefit, wants to walk away, he can walk away, or he has long-term care. So how and when to purchase a policy? One of the things I like to say is people think, well, why should you buy the premium early? Why should you buy a policy early? And because I don't want to pay premium for all those years. Maybe I should wait till I'm 70 and only pay premium for 10 years because maybe I'll use it when I'm 80. The break even is when you're younger and healthy, but when you're younger, the premium is less. So over the course of time, in Fred's example here, if he were to pay the policy for 20 years, and then go on claim, he would recoup all the premium he paid in benefit. The benefits paid out would be like in 180 days. So in less than a year, he would get back in benefit what he paid out over 20 years in premium. But the other deciding factor on why you should get a policy sooner than later, look into it, is your health. Like life insurance, you do need to be underwritten to get these policies, and they're using lots of different factors. One of the things that can work against you is family history. Family history like Alzheimer's, not all insurance companies are doing it right now, but I'm seeing more look into it, and I have some that are actually using the criteria of they may not accept you if you have a sibling with Alzheimer's, or if mom and dad both had Alzheimer's, you will not be issued a policy by some companies. Chronic conditions that aren't managed well, diabetes, uncontrolled A1C, advanced cardiovascular, currently in treatment for cancer, physical therapy. I had somebody who was getting physical therapy on her wrist, could not insure her until she was fine, until she was recovered from that, because we didn't know she was going to then need surgery. So that's where the underwriters come from. But once your conditions are resolved, your cancers, you don't have a recurrence, there's a waiting period, and they see that you come through your cancer fine, they would consider you. Joint replacement, see this all the time. Once your physical therapy is done, you're back out, you're playing golf, riding your bicycle, you can be considered. Controlled blood pressure, again, can be considered. So there's lots of things that can hold you out, but on the same token, we work really hard to find carriers that will work with you as long as you have well-managed conditions.
And Stacy, I like to say too, oftentimes when people think of this, they think of it in the same league as life insurance. And as you said, the hybrid policies on the life insurance chassis, they are. But the traditional policies are long-term care. And sometimes I've had people that didn't want to move, didn't want to even consider this or hadn't considered it because of a life-threatening issue.
Right.
And as I like to say, as dark as it may seem, long-term care companies are not super concerned about someone that may have a more short-term life expectancy as long as they spend less of that time in a nursing home. And so, ironically, it's mobility issues that maybe don't impact your life expectancy at all are more of an issue when it comes to long-term care than some of these other things. Like you said, you could get a cancer diagnosis, and as long as it's not coming back and you're getting screened and it's manageable, you could still qualify for some of these policies. So I also like to say that there are some times that people don't consider it, don't want to think about it because they feel they won't qualify,
Right.
but they might for this type of insurance.
Exactly. I like to say long-term care underwriters are really like couch potatoes.
Yes.
Have a little blood pressure, a little overweight, maybe asthma, even COPD or sleep apnea. As long as everything's controlled, great.
Correct.
Ah, so to your point, exactly. All right, should we click right through here? So in cancer is not a no, it's not an automatic no. Once we're through that stability period, easily breast cancer, prostate cancer, kidney cancer. I had someone who had a kidney, their bladder removed, and they have a belly button to instead of a bladder, and we got her coverage.
Okay.
So So how do you qualify? What do they do? How do they look under the hood? So these insurance companies will look under the hood. They all have different criteria based on age or the policies that we're looking at. But some of the criteria would be they would go to your physician and ask for your medical records. They would go do that and read your medical records. Some of them may come out, send somebody out to do a cognitive screen. They'll do a face-to-face cognitive screen, go through questions and some little drawing tests and see how you're doing that way. They just about all of them will go out to a national database for a prescription check, an RX check, kind of like a motor vehicle report, but what have you been prescribed and what are you taking now? And then the majority of them also will do a phone interview. Either they'll do the entire medical app over the phone and or a cognitive screen over the phone as well. So one of the things that I do, and I do this, James, with obviously with you and with your clients, is I will do those private calls with clients and capture their health history, and I'll talk with the underwriters to get a sense on who's interested or when could we apply, and it's all, private. No name is going in a database. It's all privacy, respected. But it gives us a sense up front, where can we go or when can we go look to insurance companies? So you don't have to get declined to find out that they're not going to take you. We can try to figure that out up front and go in feeling confident that we should have a favorable decision. If the long-term care programs aren't the right fit for whatever reason, you can't qualify medically, age may be a factor, just isn't, in the wherewithal. We do have alternative coverages and ideas that you can look at. There's traditional life insurance that offers acceleration of benefits on their contract for chronic, critical, or terminal illness. They function differently. It's not long-term care. You might not know the amount of benefit you're getting today or in the future, and they could put charges on that when you accelerate the benefit. But that's something that is out there and that people do utilize. But just know that not all life insurance, long-term care are the same. So that's one aspect. Reverse mortgages, we've seen all the actors on TV talking about reverse mortgages. And that is a solution for people to utilize if they have good equity in their home and the criteria all line up. Short-term care is a newer product that's emerging in the marketplace. The underwriting is a bit more lenient and the age band for considering people is wider and the price point's lower. And what it offers is almost a year coverage in a home care setting and almost, I can't say a year because it's like 360 days in a facility. And you could pick just to have a home care design or a facility design or both. So those are emerging, and I think I'm going to say that's a Band-Aid. It's a great Band-Aid placeholder to have if the other coverages aren't quite working, aren't palatable for you, because it will at least give you a little Band-Aid to then realign what's going on when that long-term care event happens. And then, of course, there's self-insurance, and that would be working with what you have with James and your financial picture on how to fund that long-term care event down the road when it happens. So I have covered a lot of information in a short period of time, and I hope you
Thank
can
you.
reach out to James and his team for some long-term care solutions, and that can help him help you. And James, I don't know if there's any more questions there that we can address.
I don't see any coming in at the moment. So I will because of the time, I'll jump to my part of the presentation here. And as I see questions come in, I'll pull you in for some of those. But I think some of the stuff may be addressed too on when I start presenting as well. So I will share my screen here. And Stacy, if you could just confirm for me if you're seeing my slides.
Yep, I
Perfect.
am.
Okay. So again, I wanted to give part of this presentation because Stacy, I really appreciate all the information you're able to provide on how these different types of policies work, what are some of the alternatives, and then I want to be able to give a little more examples of just why this webinar is so necessary. So I am going to scroll through this. I have seen a few other people join since my last announcement. So again, this meeting is being recorded and these slides will be available for those who have registered. It'll be on our website for people to look at that. So just some of the big questions, right? We talked about the insurances that cover expenses. We've talked about alternatives, home equity, savings. But the big question is how much does long-term care cost today and the different types of long-term care? Then there's also when should you start planning for this? And unfortunately, I think that when is getting earlier and earlier, even though people want to push it further and further out when they want to really think about these things. And then how does it impact my financial plan? And as I had said in the beginning, it's probably the biggest stumbling block that you will see in a financial plan, closely followed by grandkids. But this is a big expense that can pop up for people. And so just wanted to show, some of the average long-term care costs and who's providing it. So one of the things is a large portion of the cost is actually being provided unpaid by family. Now, oftentimes we think it's going to be the spouse that's taking care of each other. But in this case, if you look, you have spouses are 7%, right? It's your kids, your adult children that typically deal with this more than half of the time. And not only is it unpaid, but it oftentimes also requires those adult children to reduce their work hours. So not only is it unpaid, but it costs them to be able to help take care if there's not something in place to assist. Also show here, it's what are these costs? And the average cost during someone's lifetime is for women 270, call it $8,000 of additional cost that, not just your day-to-day living, but the cost for care. And for men, it's about 200,000. And you'll find for, typically women are in a nursing home more often than longer. And so that's why these costs are a little bit higher. And so insurance companies, it's the same thing, tend to charge women a little bit more because they're likely to use more of the policy. Also wanted to just show here, if you look, it's 26% of people, right? Less than a quarter, 25,000. That tends to be people that you go into a hospital and you pass away. And so there's some cost, but it's minimal. Or, you pass away at home healthy, which is kind of the way I think all of us would like to see that. But 30% of the time, the largest bar here, it costs more than $250,000 over your lifetime for costs. And again, these are additional costs for care. A more sobering way to look at this is Genworth puts out a annual study, and this is a great website. We'll include the link for it because you can put in your zip code and see. We use Manchester. That's where we're out of Bedford, New Hampshire here. So we use Manchester's area as a way to look at costs. But you can, if we're in 31 different states, so you can put in your zip code and find out. But on the bottom here is what are the different kinds of care. So in home, if you have homemaker services or home health aid, you're in the neighborhood of $79,000 to $89,000 annually to have someone. And this is in-home care. So oftentimes we think of, oh, stay home, spend a couple thousand and it'll be fine. It's a substantial increase. And you can see here, Stacy had talked about they have the inflation riders on policies. The reason you have those inflation riders is because care gets more expensive, right? Since between 23 and 24, there's a 15% increase in this average cost in the Manchester area. The scarier number, right, but the one we're planning for is a nursing home. Dementia, Alzheimer's, full physical issues that require that you can't stay in your home anymore. A semi-private room, 161 or $62,000. Or where Stacy had talked about these policies have lifetime caps, and 3, 4, 500,000 may seem like an obscene amount of money until you realize how much you're paying every year, and it's truly not. When we're looking at coverages, we want to look at either, as Stacy said, there's different alternatives for how you can pay, either getting a family assistance or family funding, your own retirement savings, insurances, which we went through. There's continuing care communities, which is a way to prepay for some of this, and then home equity. And, so when we're planning for these, there's no one of these options that will work for anyone. It's a blend, and we figure out what's the blend's going to look like. Oftentimes you're planning on selling your home, and whether you go into a nursing home, now you have that equity available. Sometimes it's selling the home and you go into a continuing care community, which the one in our area, and not trying to give any free advertising, just I've been surprised to see how many clients have looked at it, is a company called Riverwoods. is rapidly expanding. But these kinds of continuing care communities are ones where you go as an independent living, but you purchase a contract that essentially says, as you need more care, you can move further and further into their facilities. And oftentimes, these are things that you need to plan for because you don't get the same options if you have a medical issue initially, if you can't start an independent living. So these are things you need to plan years in advance for. But I've helped many clients with these applications, and one of their favorite things to see is long-term care insurance, because then they know there's going to be some assistance in your expenses later in life. So as I said, it's a blend of different things that you'd want to look at. Right? Even if family's assisting you, you need to have some of your own assets to be able to help them. Stacy had also mentioned in the slides talking about Medicaid is an option. It's been segregated in this slide because it's the last option. It's an option of last resort because it means you've spent down your savings, right? You've used the insurance. Um, but there needs to be some careful planning on this. So the big question is, which option is appropriate for whom? And our political answer is it depends. But everyone is different. And so it depends on the size of your assets, right? If you have $10 million, then you may not need coverage. You can self-insure. You can use your savings, as I said there earlier. Now, I do have some clients with significant wealth that they just want to be able to go to bed at night and say, this has been taken care of. My family won't have to pay anything. Circumstances can't change. I've bought this policy. And so there's still some people, despite the wealth, that will buy these policies. Typically, it's the life insurance one Stacy was talking about because they know no matter what, their family either gets the money back in a life insurance payout or long-term care. However, sometimes if your assets are, if you are under typically 500,000, then there are Medicaid planning options that we can do, and Medicaid may be the best option. And there's conversations around gifting and sheltering assets. And then there's middle America, most of us, right in between my 500,000 and my $10 million example, where a blend of these things is important. And it might be the life insurance tied with a continuing care community. It might be long-term care insurance, and it's going to cover this. Social Security is going to cover this, and annuity income is going to cover the rest. So there's blends of things we put in here. Family health history. Stacy said, and unfortunately, I've had clients run into this where a sibling has started to show signs of dementia or Alzheimer's, and that gets the whole family thinking. But at that point, when then they go to apply, it becomes a trickier situation because you have to say that you have a sibling with dementia, or again, you're dealing with your parents. Both parents are now presenting signs. Again, that can become an issue when it comes to applying for insurance. But it should still be if you haven't planned for it yet, there are other options outside the insurance, and this needs to be a triggering event. Same thing when it comes to leaving your child a financial inheritance, or you want them simply taking care of you and everything gets spent down over time. So that's why this planning can be important. Again, looking at what age to start considering these options. If it comes to self-insuring and saving, it's as early as possible, right? It's 30 years old because you need many years for the assets to grow to the size that they can pay for these kinds of costs, right? We're talking about, as I said, over $100,000 a year in additional medical costs if you're going into a nursing home. So the self-insurance route tends to be the route people think they're going to go. They want to go there. Insurance is effectively leverage, right? You don't have to start at 30 because you can buy one of these policies later in life, 50, 60, and right away get a big bump in what your benefit will be. So that is one thing to consider. Now, as we put on here, insurance companies will provide coverage as early as 35. Why is it important to even look at something like this at an earlier age? Well, health. You don't know what your health's going to be. You know what your family's health's going to be. So if it's something you could afford and you think is, working with our office, you feel is appropriate, then you may want to consider these earlier while you're still insurable. The continuing care communities, these, interestingly enough, I've had more and more clients interested in them, but there's a limited number of units because typically you have to move into the independent living. And so you need to wait until someone else has to move out of their independent and into assisted or into the nursing home. And what's happening is there's a little bit of a rush to do this. And so I've had a number of clients who they've applied and the wait list is 3, 4, 5 years because someone that was 60 years old jumped ahead and said, I want to do this. And now you have to wait till that 60-year-old needs care, 15 years or more from now. And so the wait lists are getting a little bit longer. So it's something else to be considering. And then Medicaid has the 5-year look back. So, unfortunately, sometimes the conversation will start with my spouse is starting to show signs of dementia. What do we do now? And that's a tough conversation to have because it's what should we have done 5 years ago? Um, but again, Medicaid planning tends to be the last option because whenever you start it, you are relinquishing your assets to qualify for Medicaid, whether it be spending them down to qualify or gifting it away to get rid of the assets in a way you qualify for Medicaid require you to no longer have control of your assets one way or the other. So I see we're coming up on the hour here, so I'll end it from there. But this is something where and Stacy, I'm going to stop sharing and everyone will see our lovely faces again here. But it's something where these conversations are just very important to have. There are multiple solutions as we've been showing here, and there's continuously growing options, more companies entering with more competitive products, which forces existing companies to make theirs more competitive. We're starting to see on the home equity space, as you mentioned, there's contractors now who specialize in fixing up homes so you can stay in your home longer. And that is explicitly what they do is they help people update their homes so they can stay longer. And they have relationships with reverse mortgage companies to help you pay for it. And so, as I said, there's a lot of these things that can be planned, but we need to consider them before year 82 and starting to show it signs. And at that time, a lot of the options may already be off the table. So I just want to thank everyone for joining us here. I don't see questions. I do know this is a very personal conversation. So if you want to follow up with myself or one of our advisors, and you have questions for myself or Stacy, I can pass them along to her and just encourage you all to think about this, bring it up in your next meetings if we haven't discussed it. Uh, One last time, this webinar is being recorded, will be available on our website. We'd love for everyone, if they do take a look at the website, you can see some other webinars that we have done in the past on other topics. And yeah, Stacy, I'm not sure if you have anything else. I don't want to end it if you had something.
I think it's important to have an honest conversation with yourself, with your spouse, and your planner and your family on what will the plan be. Just come up with a plan, and it shouldn't, if it's your family, you should include your family in the conversation. Make sure you're all on the same page. Whatever it is, you should have a plan. So when the crisis happens, there's something everyone knows what to do.
Absolutely. Thank you, Stacy, and thank you, everyone who joined us.
Thanks for having me. Have a great day.
All right, bye.
Bye.